Things have changed for crypto holders, and if you still think Bitcoin, Ethereum, and Solana live in a separate world from Wall Street, this is the moment that assumption quietly breaks. A single decision involving $100 million just turned public blockchains from a side experiment into live financial plumbing. And if you miss what that means, you risk misunderstanding where crypto actually goes from here. Because this isn't about price. It's not about a cycle. It's about what happens when the most conservative money in the world decides it trusts a public blockchain enough to run real capital on it. For years, you've heard the phrase, institutions are coming on chain. It sounded vague, it sounded distant, it sounded like something people said to stay optimistic during drawdowns. And most of the time, that phrase meant pilots, demos, proofs of concept, or private ledgers that never touched a real network. This time is different, and the difference isn't subtle. One of the largest banks on the planet, JPMorgan Chase, didn't just talk about blockchain. It launched a real money market fund, seeded with its own capital and put it directly on Ethereum. Not in a sandbox, not hidden behind a permissioned wall. On a public chain that anyone can inspect. That one move changes how you should think about holding crypto, even if you never touch that fund and never plan to. Here's why. Money market funds are not exciting. They're not risky. They're designed to protect capital, not grow it aggressively. They exist so institutions can park billions of dollars and sleep at night. When banks innovate, they always start there, not with speculation, with safety. So when a bank like JPMorgan decides the first product it's comfortable putting on a public blockchain is a money market fund, that tells you something very specific. It tells you this isn't about hype. It's about infrastructure. Think about how traditional finance normally works. Settlement takes days. Ownership records bounce between custodians. Clearing happens in batches. Every step introduces friction, cost, and counterparty risk. That's been accepted for decades because there wasn't a better alternative that regulators, banks, and institutions trusted. Now there is a real alternative, and this is where the shift stops being theoretical and starts being mechanical. With this fund, ownership isn't tracked in a spreadsheet that gets emailed around at the end of the day. It isn't updated by 3 different custodians who all need to agree on what happened after the fact. Ownership is issued directly on Ethereum itself. One shared ledger, one source of truth. No reconciliation theatre later. When a transfer happens, it settles almost instantly. Not tomorrow, not after a clearing window, not once someone signs off on a batch. It's final when it happens. Redemptions don't care about business hours or holidays. The system doesn't sleep, and there isn't a long chain of intermediaries each maintaining their own version of the truth and hoping it matches everyone else's by the end of the week. The blockchain is the record. Full stop. And if that still sounds like a minor technical upgrade, pause here, because this is the exact point where people underestimate what's happening. Institutions do not touch their core plumbing unless the upside is obvious and lasting. Banks will tolerate inefficiency for decades if the alternative introduces uncertainty. The fact that this product exists at all tells you that internally the math has already been done. This isn't curiosity, this isn't experimentation for the sake of learning. This is optimization, this is cost reduction, this is risk management, this is about removing friction that compounds at scale. Every hour shaved off settlement time frees capital. Every intermediary removed reduces counterparty risk. Every automated process lowers operational overhead. These are not small wins when you're dealing with billions. That's why the funding detail matters so much. JPMorgan Chase seeded this fund with $100 million of its own capital. Not client money, not a symbolic amount, their own balance sheet. And no, 100 million isn't large for JPMorgan. That's the point. It's large enough to matter operationally, small enough to control risk, and real enough to demand accountability. If something breaks, it's not a demo failing. It's their money. This is not marketing spend. This is a financial decision that went through internal risk committees, legal reviews, compliance sign-offs, and executive approval. Every one of those layers had the chance to stop it. None of them did. And access is restricted to qualified investors for a reason that has nothing to do with elitism. This is how institutions roll out infrastructure. Quietly, carefully, with experienced participants who understand the risks and the mechanics. Retail doesn't get the first version. Retail gets the refined version after the system proves it can handle real volume without surprises. Now, here's the part most people completely miss. JPMorgan did not choose a private blockchain. It didn't choose a closed consortium chain where everyone already knows each other. It didn't spin up a bespoke ledger, slap a blockchain label on it, and call that progress. It chose Ethereum's public network. That decision alone carries more weight than any quote in the announcement. Because a public blockchain means shared security, shared liquidity, shared standards. It means JPMorgan is willing to rely on infrastructure it does not fully control, because that infrastructure is resilient enough to trust. Ethereum already has what institutions value most, and none of it is ideological. It has deep liquidity that doesn't disappear when markets get stressed. It has a validator ecosystem that's been attacked, tested, and pressured in real conditions, not simulations. It has integrations with custody providers, compliance systems, and stablecoins that actually move serious size, not test transactions. And it has history, years of uptime, battle scars, and incremental improvement. That's why this decision fits into a much broader pattern you've probably noticed without connecting all the dots. BlackRock didn't tokenize assets because it's trendy. It did it because tokenization reduces friction. Fidelity didn't explore on-chain settlement for fun. It explored it because legacy settlement is slow and expensive. UBS and State Street followed similar paths for the same reason. Invesco and Deutsche Bank didn't chase speculation. They rebuilt conservative financial products using crypto rails. Different institutions, different geographies, same direction. That's not coincidence, that's convergence. Ethereum isn't becoming a settlement layer because people are cheering for it. It's becoming one because it already solves problems institutions are paid to care about. Uptime, predictability, integration, auditability. Those things matter more than narratives. Institutions don't argue about which chain is cooler. They ask which one works today at scale, under pressure, with existing systems. Right now, Ethereum checks those boxes in a way no other public network does at the same level. And this is the point where holding ETH quietly changes meaning. When financial products move on-chain, they don't just use the network the way an app uses an API. They depend on it. Their operations assume it stays secure, neutral, and available. And anything that depends on Ethereum's security has a built-in incentive to support that security long-term. Validators stake ETH to secure the network. That staking isn't cosmetic, it's economic weight, it's skin in the game. Staking yields exist because the network needs that weight to remain credible as value increases. As more assets settle on Ethereum, the cost of failure rises. As the cost of failure rises, the importance of robust security rises with it. Over time, institutions that rely on Ethereum's uptime don't just want access to the network, they want exposure to the asset that underpins it, not out of belief, out of logic. That's the feedback loop most headlines never talk about. Usage creates dependency. Dependency creates alignment. Alignment creates demand that doesn't care about hype cycles, influencers, or short-term price action. Now zoom out for a moment because all of this is happening while sentiment feels awful. Prices are volatile. Confidence is fragile. A lot of retail investors feel burned, bored, or emotionally exhausted. It feels like nothing is happening. But underneath that feeling, the machinery is being rewired. Quietly, methodically, without asking for attention. And that disconnect between how it feels and what's actually happening is exactly why this moment matters. Meanwhile, while all of this feels quiet on the surface, behind closed doors, the actual financial infrastructure is being taken apart and rebuilt piece by piece. And this is the part you rarely see headlines about because it doesn't look dramatic. It looks like committees. It looks like internal memos. It looks like risk teams slowly changing language from "we don't touch this" to "how do we touch this safely?" That shift matters more than any tweet or price candle. Look at what's happening with firms that spent years publicly distancing themselves from crypto. Charles Schwab didn't wake up one day and suddenly love blockchain. It softened its stance because client demand didn't go away and the infrastructure kept improving. When a firm like Schwab changes tone, that's not marketing. That's an internal recognition that ignoring something is riskier than understanding it. Vanguard followed a similar path. For years, it was openly dismissive, not skeptical, dismissive. Now that posture has shifted, not into enthusiasm, but into cautious acknowledgement. And for institutions like Vanguard, that is a massive move. They don't reverse public positions lightly. Then look at payment networks like Visa. Visa isn't building advisory practices around blockchain-based money because it wants to speculate. It's doing it because its core business is moving value, and blockchain-based money is becoming part of that landscape whether anyone likes it or not. These organizations don't chase trends. They don't experiment loudly. They wait. They observe. They let others absorb the early risk. And then they move when something becomes inevitable. That's the pattern repeating right now. At the same time, regulation is doing exactly what regulation always does during real technological shifts. It's slow, it's messy, it's frustrating, and it's directional. Stablecoin frameworks are advancing because regulators understand that digital dollars aren't going away. Market structure rules are being debated because crypto markets are now too large to ignore, but too immature to leave untouched. This isn't about banning crypto. If it were, that conversation would already be over. This is about absorbing it into existing systems, defining boundaries, and reducing uncertainty for institutions that need clarity before they deploy real size. And that's why industry leaders like Brian Armstrong keep showing up in Washington, not for photo ops, not for headlines. They're there because institutions do not move serious capital without rules they can point to. Pension funds, asset managers, banks, and insurers don't operate on vibes. They operate on mandates. And mandates require clarity. That clarity doesn't arrive all at once. It forms slowly, through guidance, through court decisions, through negotiated frameworks, piece by piece. And as frustrating as that feels in the moment, it's exactly how integration happens. Now here's where the emotional disconnect hits a lot of crypto holders. You open your portfolio, you see drawdowns, you see assets that haven't moved the way you hoped, and a quiet question creeps in. Was holding through all of this actually the right call? That feeling makes sense, it's human, it's rational, but it's also incomplete. Markets don't reward how things feel in the moment. They reward how well positioned you are relative to what's actually changing underneath the surface. And historically, the biggest disconnects show up when price action and infrastructure development move in opposite directions. When the chart looks boring or painful, but the foundation is quietly getting stronger. By the time prices start reflecting structural progress, the positioning opportunity has usually already shifted. The easy part is gone. This cycle is different from the ones most people emotionally remember. It's not retail mania first, it's conservative adoption first. It's boring products, it's slow rollout, it's cautious capital. The loud phase comes later, once the plumbing is already in place. And this isn't just an Ethereum story. Bitcoin benefits from this shift in a way that's easy to miss if you only think in terms of direct usage. Institutions don't need to transact on Bitcoin every day for Bitcoin to benefit. They don't need to issue funds on it. They don't need to settle trades on it. What Bitcoin provides is something more fundamental. It anchors crypto as a legitimate asset class in the minds of the most conservative decision makers on the planet. When large institutions accept that public blockchains are real financial infrastructure, Bitcoin stops being framed as an experiment on the edge of the system. it starts being treated as the reference point, the baseline, the thing everything else is measured against. Not because it's fast, not because it's flexible, but because it's simple, scarce, and impossible to dismiss. For years, Bitcoin lived in a strange category, too big to ignore but too unfamiliar to fully accept. It was treated as a speculative side bet, something adjacent to the real system. Now that banks and asset managers are actively building on public blockchains, that mental model breaks. Because once you accept crypto isn't a phase, Bitcoin's role changes automatically. It becomes the neutral, non-sovereign asset sitting at the center of the conversation. Even if it's not the chain being used for settlement, even if it's not the fastest or most expressive, it becomes the digital reference asset. Think about gold. Most financial products don't run on gold. Most payments never touch it. Yet gold still benefits whenever trust in the financial system is questioned, reshaped, or restructured. It sits outside the system, but it anchors it psychologically. Bitcoin plays a similar role in a digital world. It doesn't need constant transactional usage to remain relevant. It needs recognition. It needs legitimacy. And every on-chain financial product launched by institutions makes that recognition easier. Each one quietly reinforces the idea that crypto is infrastructure, not a fad. And once that idea settles in, Bitcoin stops being optional to understand. That's the deeper shift happening beneath the noise. Because once crypto is treated as infrastructure, Bitcoin becomes the simplest way to hold exposure to that infrastructure without taking on platform-specific risk. That's why institutions don't have to love Bitcoin to respect it. They just have to accept that crypto isn't going away. Now, Solana benefits in a very different way, and this is where the picture gets more nuanced. As tokenized assets expand, not everything can live on a single chain forever. Institutions care about speed, cost, and user experience, especially when they start imagining high-volume activity. Things like real-time collateral movement, high-frequency settlement, and complex interactions between tokenized assets demand throughput that goes beyond conservative base layers. That's where high-performance chains become relevant. Solana isn't competing with Ethereum in the same way retail debates frame it. Institutions don't think in terms of chain loyalty. They think in terms of workload. Certain tasks need maximum security and neutrality. Others need speed and efficiency. As more financial products move on-chain, different chains naturally specialize. Solana's value proposition isn't ideological, it's operational. If tokenized markets grow large enough, there will be demand for environments that can process massive volumes without friction. That doesn't mean institutions abandon Ethereum, it means they expand outward from it. And this is the key point that often gets lost. Ethereum becoming the base settlement layer legitimizes the entire space. Once the most conservative institutions in the world accept a public blockchain as a foundation, everything built on top of that foundation benefits indirectly. The conversation shifts from which chain survives to how different chains fit together. That's a very different future than the one most people are emotionally reacting to during market volatility. This is why things have changed for crypto holders. Not because prices are higher, not because narratives are louder, but because the people who decide how trillions of dollars move are no longer asking whether blockchains work. That question is already settled internally. They're asking how to integrate them safely, compliantly, and at scale. And when that question changes, the timeline changes with it. Innovation doesn't look dramatic at this stage. It looks dull, it looks slow, it looks cautious. You don't see fireworks, you see plumbing upgrades, you see boring products, you see conservative capital testing the rails before committing more weight. That's not a sign of weakness. That's a sign of seriousness. Real financial transitions don't announce themselves with excitement. They happen quietly, behind the scenes, while most people are distracted by price charts and headlines. Think about the internet again. The moment that mattered wasn't the flashy website that everyone talked about. It was when back-end systems quietly moved online. Accounting systems, logistics systems, payment processing, those shifts didn't feel exciting at the time, but they changed everything that came after. Finance is going through that same phase right now, and if you're holding crypto, your role isn't to guess the next pump or react to every drawdown. Your role is to understand what kind of system you're actually invested in. Are you holding something that depends on attention, or are you holding something that's becoming part of the financial operating system? Because once institutions commit infrastructure, they almost never reverse course. They don't tear it out and start over. They build layers on top of it. They add complexity, they add volume, they add integrations. That's why this moment matters more than it looks. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Now here's the final shift I want you to sit with. Crypto doesn't need to replace traditional finance to win. It doesn't need to overthrow it. It just needs to become the rails underneath it. Quiet, reliable, boring, and indispensable. And that's already happening. When a money market fund lives on Ethereum, that's not crypto trying to join Wall Street. That's Wall Street admitting that public blockchains solve problems. Legacy systems can't solve efficiently anymore. Things have changed for crypto holders because the question is no longer whether institutions arrive. They're already here. The only open question now is who understands that early enough to stay calm, think clearly, and position themselves without letting emotion take over. Subscribe or watch the next video.